Break-even analysis. It examines the short-term relationship between changes in volume and changes in total sales revenue, expenses, and net profit. It is also known as cost volume profit analysis. Cost volume profit analysis is an important tool in terms of short-term planning and decision making. It looks at the relationship between cost, revenue, output level, and profit. Short run decision where cost, volume, profit is used include choose of sales mix, pricing policy, and so on. Decision making and break even analysis examples are how many units must be sold to break even, how many units must be sold to achieve a target profit, should a special order be accepted, how will profits be affected if we introduce a new product or service. Key terminology break even analysis. Break even point, the point at which a company makes neither a profit or loss. Contribution per unit, the sale price minus the variable cost per unit. It measures the contribution made by each item of output to the fixed cost and profit of the organization. Margin of safety, a measure in which the budgeted volume of sale is compared with the volume of sales required to break even. Marginal cost, cost of producing one extra unit of output. And break even formula, fixed cost divided by contribution per unit. Contribution equal to selling price per unit minus variable cost per unit. You can see the break even chart, which is in which the total revenue start from the 0 point and total cost is above the total revenue, and then they are break on the 1 point where the total revenue equal to the total cost, and that point is known as a break even point. Margin of safety, the difference between budgeted or actual sales and the break even point. The margin of safety expressed in units or revenue terms show the amount by which sales can drop before a loss will be incurred. Using the following data, calculate the break even point and margin of safety in unit in which selling price 50, variable cost 40, fixed cost 70,000, budgeted sales 7500 units. Contribution 50 minus 40 is 100 per unit. Break even point 70,000 divided by 10 is divided by 10 by the contribution is equal to 7,000 unit. Margin of safety 75,000 minus 700 equal to 500 unit. Target profit. What if a firm does not want to break even? It means it requires a target profit. Contribution per unit will need to cover a profit as well as fixed cost. Required profit is treated as an addition to fixed cost. You can see the example in which you, by using the following data, calculate the level of sales required to generate a profit of rupees 10,000 in which selling price 3500, variable cost 20 and fixed cost 50,000, contribution 15 and level of sales required to generate a profit 50,000 plus 10,000 divided by 15 equal to 4,000 unit. Limitation of break-even analysis in which costs are either a fixed or variable. Fixed and variable costs are clearly discernible over the whole range of output, and production equal to sales. One product it means that constant sale makes selling price remain constant, efficiency remain unchanged, volume is the only factor affecting cost. Use of that cost data in managerial decision. Firstly, for the make or buy decision, it's related to the with the producing an item internally and buying it from the outside supplier. In these circumstances, two factors are to be considered: whether surplus capacity is available and the marginal cost. Elements of make analysis include incremental inventory carrying cost, direct labor cost, incremental factory overhead cost, delivered purchased material cost, incremental managerial cost, any follow on cost, incremental purchasing cost, incremental capital cost. Shutdown cost. Sometimes it's become necessary for a company to temporarily close down their factory or unit because of the trade downturn with view to reopening it in the future. In this situation, decisions are based on the variable cost analysis. If selling price above the variable cost, then it better to continue because the losses are minimized. By closing the manufacturing activity, some extra fixed expenses may be incurred and certain fixed expenses can be avoided. Such costs are also relevant. Then decision is based upon whether the contribution is more than the difference between fixed expenses incurred in normal operation and the fixed expenses incurred when the plant is shut down. So now introducing a new product, there are the two reasons why a commercial enterprise should undertake the time, efforts and expenses of introducing a new product or services in which customer have shown shown interest, demand is sufficient and sustainable enough for the proposed product to make a profit. In other words, successful enterprises sell what customers want to buy rather than what the entrepreneurs want to sell. So now introducing a new product, all relevant costs should be recovered over a period of product life. Joint product. When two or more products of equivalent importance are produced simultaneously, they are termed as joint product. In other words, two or more products separated in course of same processing operation, each product being in such proportion that no single product can be designated as a major product. So joint product usually require further processing. You can see joint product cost allocation in which crude oil in which joint production processes carry forward, and then there is a split of petrol and diesel which is called a separate processing cost, and the separate processing cost is required the final stage. Next is a byproduct. It is basically relatively small total value that is produced simultaneously with a product of greater total value. The product with the greater value is usually produced in greater quantities than the byproduct. In other words, when two or more products are separated in course of the same processing operation, where one of the product being in such a proportion or value that it can be designated as a main product, while other are considered as byproduct. For example, in corn, coke manufacture gas and tar. In lumber mills, sawdust. Cotton cleaning process, cotton seed. Coconut oil industry, coca shells.